Most people think a passive portfolio is set it and forget it. The truth is, if you don't understand how money flows, what drawdown really means, how diversification works, then your portfolio can surprise you, and not in a good way. Since 1994, one of the properly diversified portfolio that I use has averaged around 9% annual returns with less than 10% maximum drawdown. That's the power of understanding the mechanics and not guessing the market. In this video, I'll walk you through the concepts behind building a passive portfolio, how money flows, how equity curves and drawdown behave, and how diversification can protect your capital and your psychology. By the end, you'll understand why diversification is not just a buzzword. It's a framework for confidence, control, and consistency, no matter what the market does. Remember to subscribe for more insights like this. Let's dive in. I'd love to talk a bit about portfolio diversification, right? And this is different from active trading, of course, and taking trades, taking active position in single assets. And here it's more, the way I look at it is more like just a lot more return on your money versus a saving account, right? Of course, risk is subjective, right? You could argue that leaving all of your savings under the same in the same bank account managed by the same bank is also risky, right? What if the bank fails and so on? Happened in the past. I like the idea of passive investment because it's really about taking things into your own hands, right? And in order to do that, I think that understanding at least a little bit what the markets are made of and what diversification means is just really beneficial and give you that confidence to hold and stick to your strategy as the decades go by, right? So how do we build properly a passive portfolio that can actually protect you when the market gets scary? So let's try and understand a bit how the capital flows first, right? So different assets are driven by different economic forces. So the money basically doesn't move in one direction across all assets at the same time. And that's why combining them smoothes the equity curve. So these forces, they basically rarely line up perfectly, right? And if you combine these assets, it's going to cause them to partially offset one another, right? So when one suffers, another one might hold steady, often hold steady and benefits. So mathematically, right, it compresses drawdowns and it reduces volatility, right, while keeping most of the long-term return potential, right? So the core logic here, there's two things, right? Basically, when money is easy and safe, investors are going to move into risk assets like stocks, like crypto, maybe real estate. And when money gets expensive or dangerous, investors are going to retreat from the risk assets and move into safe assets like bonds, cash, and gold. So expensive money here means high interest rate, and dangerous environment means like a fear of a recession or a crisis. So here we have a simple, money flow map. So when interest rates are low, that means borrowing is cheap, liquidity is high, the money is abundant. Capital investors are going to flow into stocks, crypto, maybe real estate, so more risk assets, right? Because the safe assets are not paying anything, right? Interest rates are low, so government bonds are just not attractive. So investors are hunting for high returns. Then when interest rates are rising, it means that money becomes more expensive. The liquidity is going to drop. So you're going to have the capital flowing to bonds or cash. And why? Because suddenly bonds is paying an attractive yield, right? And cash stop losing value. So the capital is just going to leave the risk assets like stock, crypto. And an investor might basically tell himself, why would I take risks in stocks if I can get a real attractive yield with bonds, right? Guaranteed return with government bonds. But this is one of the biggest driver of market cycles. A third scenario, when fear or panic hits, right, regardless of interest rate, that might be recession, there's a war, geopolitical shock. So capital, once again, here is going to flood to safe assets, right, bonds, cash, and gold, because safety is just way more important than return at that point, right? Massive fear, massive uncertainty. You want to make sure your hard-earned cash or savings are protected. So capital is going to dump basically stocks, crypto. The risk asset just get liquidated first. Safety first. And when the crisis ends and the confidence return, expectations stabilize. The central bank maybe are easing the interest rate as well. Capital is going to rotate back into stocks and crypto, right? So the investors are re-entering the high return risk assets. So that whole thing basically can be summarized in one short line. Low rate and confidence equate risk assets. High rates of fear, safe assets, right? And that's about it. So in a nutshell, this is a very simple explanation of it. Of course, there are way more mechanics, leverages, and things going on. But that's basically why some asset classes move in opposite direction and why diversification works. And that's what interests us as investors, and to build a long-term, multi-decade, long horizon, diversified portfolio. So to illustrate that, I've chosen to show you 4 different portfolio. In dark gray is the SP 500. So this is from 1994. Dark gray is SP 500. In light gray is a classic 60-40 stocks and bond diversification. In green is the all-weather portfolio from Ray Dalio, so even more diversified. And in blue is my preferred allocation, right? The one that I use and that I think is just like really, really good and resilient. So what's very interesting here is you can see the difference in terms of drawdown. So between Jan 1994 and October 2025, you can see that, the simplest investment is just, buy and hold SP 500, but look at the massive drawdown it had, right? It had a minus 50.8% drawdown, right? That's huge. That means at one point, right, your holdings were worth half of their value prior, right? And that might be extremely difficult to hold as an investor, right? The problem with that is, can you stick to the strategy when things get tough, right? So the best strategy is not going to be the one that delivers the best returns. The best strategy is going to be the one that you're able to stick with when market takes a downturn. That's it, right? So if we diversify a bit, look, just a 60-40 split stocks bond is cutting the drawdown by 20%, right? That's huge, almost half, right? The all-weather is at 26% drawdown at the worst, right? So that's half of the SP 500. And the portfolio that I really, really like is about under 10%. So that's like 5 times less, right? That's huge difference. Look how much smoother the blue line is compared to the SP 500, for example, and the other portfolio, right? So that's what you want. For me, right, if I'm going to invest my money for decades, if I'm planning, to use that for retirement, maybe for children education, to buy properties when I'm old, if I'm planning to, if I'm going to rely on that money, I want that to be a smooth ride, safe, and I want to be able to stick to it, right? So I don't want to be going through roller coasters, right? And I'm willing to sacrifice a little bit of performance to have peace of mind and to actually execute the strategy. Because the worst thing that could happen here is, you're hitting a 50% drawdown on the SP 500 and, you're just afraid. You can see, your past 30 years of savings and investment just dwindling, cut in half, and you sell. And that's the worst thing you can do because you literally realize your losses, right? So I much prefer to, sacrifice a little bit of performance, but still keeping a really good performance. Now if you look at the annual return, right, the SP 500 is at 10.75% since 1994, so that's very strong, right? But the other one are about the same, right? So about 2% less. They're all about the same value, around 8.5%. But look at the drawdown difference, right? The portfolio in blue just has less than 10% drawdown, still keeping 8.34% profit year on year on average. That's still really, really good, right? I think that if you look at the value of $10,000 back in Jan 1994, should you invest nothing else but those $10,000, would equate to 140,000 or something at that point if you look at the chart. So that's what I like, right? That's what I like to do. I think that if you're looking at more aggressive returns, there are other ways to do better, like active trading, swing trading stocks, which I do as well, or having really risk-oriented portfolio. But you're gonna have to allocate most likely a lower percent of your capital as well to that, right? For the reason that I just explained. So if you're interested in learning how to do that, feel free to go on my website, drop your mail. I'm currently building a way to teach that basically, and I will be notifying everybody who dropped the mail whenever it's released. So if you're interested, hit the website, drop your mail, and follow along.